What's going on, Penny Boys and Gals, and welcome to our Penny Boys University live stream. This is for our premium members. We are currently live in the lounge. We do this every Thursday, 2 p.m. Eastern. Today we're doing it 12 p.m. Eastern because Pookie's has some very important business to attend to later. But going forward, this will be at 2 p.m. Eastern. Where are you traveling, Pookie?
I'm going up to Lake George.
Ah, cool.
Yeah, it'll be fun. Gonna be in the mountains, so no internet.
Oh, is that like where I don't know nothing about Lake George. I'm not bad at maps. Is that like near the Adirondacks or near the Adirondacks, or is that
yeah, it's a big puddle in the middle of the mountains.
You gonna splash around?
No, I won't. Well, yeah, maybe, I don't know. I'm up there.
Right, for those of you tuning in, we are going to be talking about Fibonacci retracements and extensions, the difference between each, and how Pookie's Revenge uses them in the market. And we are currently in market hours. The market is currently open, so we can even do some live examples as well. As we all know, this week is charting week, and in our Wednesday PB Live, we kind of went over the basics of Fibonacci, but this is going to be going over it in a lot more detail because Pookies knows all things, and we're just going to ask him any question in the chat about Fibonacci. Feel free to ask it, and if he doesn't answer, then we have to fire him, unfortunately.
You said that like Squiscar from Metalocalypse.
I have no idea what you're talking about. I have to look it up.
Things.
Yeah, grammar. Well, we're trading here. It's a trading class, not an English class, thankfully. So
there you go.
Let's get into Fibonacci. Let's start with the Fibonacci retracements.
All right.
We already went over how it works kind of in our last class. But if you want to basically just kind of go over like what the basic definition of a Fibonacci retracement is, and then we'll kind of talk about how you plot them, because I know a lot of people do have problems or struggle when it comes to finding the swing highs and swing lows. But let's just go over a quick basic overview or definition of what is that? Was that your notepad?
Yeah, so basically Fibonacci is you do something like this over and over and over again, and you just you incrementally make things smaller by a given amount. Obviously, it's a pattern found in nature. I'm not going to go into like the specifics of how Fibonacci is calculated and all that good stuff, but just understand that it's a series of proportions that is very pervasive throughout everything, the whole universe. So with that said, it ties in heavily with statistics, and it's not ever a guarantee, but it is something that is gaining a lot of influence and has been gaining a lot of influence due to the Pygmalion effect, which you may or may not remember, is a self-fulfilling prophecy mechanism, which means that the more attention or the more belief something has, the more likely it is to manifest. So things like Fibonacci numbers in trading, for example, at the root level, it's just a measurement. But a lot of people now use those as buy and sell signals at those levels, and that's obviously not what we're doing because we're not gamblers, but we can use it for what it was intended to be used for, which is a tool. So when and where is it appropriate to use a Fibonacci retracement? First and foremost, the main function of it, the primary purpose, is as a retracement tool for impulses. So every time you see an impulse, which is either just a huge move in price or a series of 5 or more candles which don't break the high or low of the previous candles consecutively. So in this case, we have all lower highs. You can see the price just kind of pushes down until right here.
So basically 5 big bad candles or 5 really good candles.
Yeah. 5 candles that just don't break direction, I guess is the best way to put that. So that's a technical impulse, and we now know we have the beginning of that impulse as well as the last candle of the impulse, and we can use that to draw our fib from there to there, and then kind of measure how the supply and demand process kind of resolves itself after that point. And that's all we're doing.
Really quick, when it comes to drawing those out, what you're doing, like for how do you personally, or because I know I've looked it up on, online, I personally use it a different way than some of the places online tell you to do, and some of them tell you different things. How do you personally find your starting and your ending point?
You mean like how do I pick which direction I draw it, or how do
I because some people do based off the first candle like prior to the break. I know some other strategies have different ways. I'm curious which one you use.
Yeah, so in this case, I just use the number of candles that have for this specific type of impulse, since it's multiple candles in a row which fail to break highs. I use the highest candle, and then I use the lowest candle of that, or the low of whatever that range was before the impulse broke. So in this case, this white candle here broke above the high of this previous candle. So that is the last candle right here, the impulse. So the impulse itself extends from there to there. So I'm drawing a fib from the highest candle to the lowest.
Gotcha. And you use the wicks.
Yeah, I do.
Perfect.
Yep, cool. Now, there is a lot of controversy too as to which direction you should draw them.
Oh, right.
And if you think about it, right, what we're doing is we're measuring a retrace. We're measuring a pullback in price. So if I draw it from the beginning to the end, and let's say I'm in a cabin in the middle of the woods and I'm walking out in the snow, and I go maybe a little too far, and I say, okay, I want to start walking back to my cabin now. I'm going to follow my footsteps back and think of this as the cabin, this as the point where we realized we were probably a little bit lost or a little farther away than we wanted to be. I'm going to retrace my footsteps in that direction. And when I get halfway back to the cabin, that's going to be this 50% level. If I walk back a little bit less than that, I'll be less than 50%. So the lower numbers should be towards the end of the impulse, and the higher numbers should be towards the top of the impulse. So in this case, we're drawing a bearish impulse, so I'm going to draw the line down. If it's a bullish impulse, I draw it up.
So like left to right, basically.
Yeah, pretty much always. Yep. But it depends on whether or not the price is increasing or decreasing.
Right.
Now, you can draw it backwards. It's not really going to matter too much, but that will potentially skew the interpretation you have of that price action. So you got to just be careful with it. Whatever you do, just be consistent. Yeah, so Fibonacci retracements are a measurement tool. And we know that we have some tricks we can use based on that. So obviously, well, actually, before we get into the tricks, I want to just talk about what a Fibonacci retracement actually is, or what a retracement is. When we have an impulse, people in this case are selling up here and they're buying down here, right? There's the supply, there's the demand down here. People have cash, they want shares, they're stepping in right here. So people that shorted the stock or took out puts, they want to lock some profits on the way down or at the bottom, and buyers want to step in and kind of resolve that impulse. So all we're seeing is a shift in distribution. And what that means is that we can measure the quality of profit taking versus people jumping in and assess whether or not we're likely to see a reversal or continuation or consolidation, and then look for entries based on that. So the perfect level that we really, really like to see is referred to as the golden mean, and that is a 61.8% retracement. And the reason for that is because that represents a healthy resolution of that impulse. So it just means that enough people have taken profits, enough people have bought in. That's a pure decision zone at that point, and the likelihood of it proceeding for continuation is kind of made or broken at that level. So if it goes above the 61.8 on a bearish impulse, it's likely to reverse and be bullish. If it stays below that 61.8% level, ideally between the 50 and 61.8, sorry, the likelihood for it to reverse and see H-shaped continuation to lower lows is much higher.
So it's like the healthy golden fib right there. It's like, as far as the retracement goes. I like how you put that one.
Yep. So we want people to, sorry, we typically like to look for reversals in this area, or if it breaks above that, that's when we look for an actual trend reversal and things like that. So obviously this is not a buy signal. Just because the price is in here doesn't mean you want to buy it. But this is where we can look for those tiny little engulf entries and maximize that risk reward. And then if we're wrong, it's okay, because we have a super tight stop loss. And if we're right, we've got the potential for it to go much, much farther down, giving us disproportionate profit to loss risk exposure. He's good.
So I know when it comes to the different Fibonacci levels, like, you just talked about the golden retracement. Obviously, that's not always where it's going to have that reversal point, continue that, in this case, downtrend, sometimes uptrend, or just the overall trend. When it comes to some of your other retracement levels, let's for instance talk about like the 23.6%, which is considered a shallow retracement.
Let's get rid of that.
I know like flags might happen here. How do you personally know when to look, at like which level to look at when it comes to different types of trends and different type of movements?
So that really depends on what type of impulse we have. So if it's a strong push to the downside, we know that 90% of the time we're going to get a pullback at least to 25%. That happens 9 out of 10 times. That's very tradable. The challenge there for that specific type of bounce play is to get in below the 12.5% level, because we want that greater than 1-to-1 risk reward. So that means that the impulse has to be pretty long in order for it to provide a confirmation in this little range down here. And if we don't get it, we just don't trade it. And that's okay. It's always better than trying to guess the bottom and then being wrong. But if we see a confirmation down here, we know that we can take profits up here. And then we have a greater a healthy risk reward. If we have something like this where it's a little bit slower, a little bit more paced out, but it's accelerating, that tells me I really want to look at this 61.8 to 50% retracement level as a retest, because this acceleration shows bearish strength, but it also provides an opportunity for a discount for bulls. So this level tends to have a little more value. Now, 50% retracements happen about 60% of the time, so more often than not, but not by much. 61.8% only happens about 40% of the time. And that's just something touches this level and then pushes. And that means that anything above that level for a bearish retracement, you typically don't want to look for a bearish entry at that point because it's just bullish.
Yeah, so when it comes to that, like, because obviously, we can use the retracements to either find possible entry zones, but also, and find possible areas where the stock retrace and is going to continue the overall trend. But when it comes to a possible reversal and using Fibonacci, what do you personally do? Like when it does cross that, the golden retracement, and keeps going up in this case, like how do you personally decide that? Oh, like the Fibonacci retracement is not, I guess in this case, valid. It broke the Fibonacci retracement and possibly is going to continue the uptrend in this case. Like, is there, like, how do you know when to actually look for that using other indicators? And then how do you decide your next steps as far as that goes?
Yeah, so it depends on the neighborhood we're in, right? So obviously for the Fibonacci retracement, we're only really looking at this area, right? This is all we're looking at. We're not looking at anything off to the left, which means we're missing the overall trend and the overall bias. So at that point, I would just zoom out and say, okay, in most cases, when you have an impulse to the downside like that, you automatically have a lower low. So typically, once we're above this box here, that's when I start to look for higher highs and higher lows to form. And that's it. We're really, if you're using the fibs, you really just want the price to kind of compress into this box, this golden mean. And then you want to look for a confirmation in the direction of the impulse. That's just for continuation. Once it breaks above this, the fib is not something you can really rely on. So at that point, once it breaks above the 61.8, you can pretty much just delete the drawing because that level's invalidated. Now, this box will still typically act as a support and resistance, because if you draw an average of price between here and here across this impulse, that's all we're looking at. We're just looking at an average, distribution mean, if you will. So it's not necessarily invalidated. It's just we can't use it as a measurement tool other than it telling us we have a deep retracement. So it's just not a very good trade setup at that point for a bearish direction.
Gotcha. I'm just trying to I want to see how we could use this when it comes to just when it comes to alerts. I'm trying to find a current alert that might be somewhat close to to open. Probably a swing alert would be the best bet, right?
Yeah, go ahead and just pull one up. We'll take a look.
Let's see. I'm trying to find one that didn't either hit target. Yeah, I think snow hit target. It looks like so. Actually, no, Leah, let's look up. That's BTCJ. Do you have any alerts currently open?
Yeah, I got a bunch. I got Fisker, KLXE. So if we want to look at, KLXE is more of a trend line break here. But if you were to look at this as a fib right here, obviously it's a little choppier because there's some price action in the way. But you'll see this 50 to 61.8% level held, and we're pushing to the upside. So specifically, this guy right here would have been the engulf entry on that, because it not only breaks out of the box, but at one point this was a solid bullish candle and it consumed the candle before it. So that would have been a very easy, low risk entry opportunity if you missed the initial alert. But that's a pretty good one.
Well, that's a good point. We can use these retracements to I hopefully get that second wave back up on these alerts that still have room to go.
Yeah, and it's scalar too. So if you look at this right here is a technical bullish impulse. So if I were to draw a fib retracement right here, and then I look right here at the 50 to 61.8, you would look for an entry opportunity to the upside, and you'd get one right here on this guy. Very, very low risk. I mean, look at how small that risk is. In this case, so if I were to draw that, and I'm kind of going down a rabbit hole here because this is how we introduce position size management and all that good stuff. So if you're just trading equities and you just want to trade nice and small, that would have been an easy entry right there if you're just watching this impulse and that 3-line strike that we see most of the time. And then just set yourself a 3-to-1 risk reward, or 2.5 in this case, because it wants to snap to the high. Let me just edit that. So it's 3-to-1. Too far. All right, so that would have been 3-to-1. You would have hit target on that one. Obviously, it's not a guarantee that you're always going to, but that is an easy way to make 42-cent profit. In this case, we're only risking 14 cents. So pretty easy, pretty repeatable, something that we can measure and define and have specific levels to watch and things like that. It applies to all time frames. And again, it's not a guarantee that you're going to get a profit every single time. But if you focus on getting 15 successful trades in a row, rather than trying to get 15 profitable trades in a row, you're going to have a much better time.
Yeah, and I like these retracements because, like you said, you don't have to only use them to get in on an alert that's currently at entry. Like if, for instance, like our blue chip channel or our an analyst channel, if some one of the analysts are talking about stock that they currently see in a very strong trend, whether it be uptrend or downtrend, we can now know that the analyst sees us in a current trend, and we can play that trend by using retracements, and of course other stuff that we learned as well in the course, to just continue playing that stock on the ups and the retracements and the ups and the retracements, and just basically rinse and repeat until one of them fails and we see that reversal. So I like being able to use these types of strategies outside of just buy and sell at alert entry and alert target.
Absolutely. And that's kind of why I've been pushing the engulfing stuff on people, because A, it's easy to understand. Is this candle bigger than this one? B, it reduces that risk a lot, because if you're looking for something with a maximum risk of like SPY, for example, if you're just trading with opportunities that only have 20 cents worth of risk exposure, you know that your risk is always going to be that or less, which means that your guaranteed profits are going to be at least 40 cents if you're using a 2-to-1 or 1-to-2, I'm sorry, worth of price action. So obviously that changes a little bit with the options, but it takes a lot of the guesswork out of the trade, and it takes a lot of the unknowns out, which reduces stress. So if we look at this right here, for example, this impulse, this 442.75 up to this high right here, this one only came back to the 38.2, but you can see it held very well before pushing back up. So this is a shallow retrace, which means it's likely to take off sooner rather than later, and it's likely to sell off harder later. Now, this is a 38.2, so it's still kind of healthy. But if you get a pullback that's like 10%, that's likely just a hiccup, and it's just going to push higher and faster and then sell off that much harder later, because the fact that it failed to get to that healthy level means not enough people took profit. And that's really what we're doing here. We're just identifying the amount of people, or the strength of people taking profits versus people jumping in for that rally for continuation. And when we don't come down here to the 50 to 61.8%, that's a short-term sign of strength, which is good, but it also means there's that many more people that are likely to take profit later. So sell-offs might be a little harder on shallow retraces, but the rallies might be sooner and more violent as well. So there's a little bit of a trade-off, and there is always a risk. I'm sorry, not a risk. There's always a chance that when you get a deeper retracement below that 61.8, they could turn into a Hail Mary, because it is still an extra discount for buyers for a bullish retrace. The probability of that happening is much lower, but they are more impactful. So if that happens to line up with some other setup, like a double bottom, for example, those tend to pay out really well, but you don't just want to grab stuff blindly because it's at the 50 to 61.8. You really want to look for a confirmation after that fact.
So let's move on to extensions now.
Cool, let's do it.
So what is, we're just going to go with the basics for those who didn't take the class yet. What are the biggest differences between extensions and retracements?
So the retracements are 2 points, which means you draw a starting point and an ending point. The extension is used to measure the potential continuation after the retrace happens, which means it's 3 points. So if we were to use an extension here, I'm just going to erase all these lines because we kind of know where it's, I'll leave the actual retrace line, or the zone in there, right? Because we like that. If I were to draw a retracement, I'm looking under the wrong thing. Geez. If I drew a retracement, it would just be here to there, and it would kind of tell me the area. It would give me that measuring tool for the retrace. Now, if I know exactly where the that retrace actually pulled up to after the fact, obviously we want to wait for it to validate and all that good stuff. Then we could draw that third point, which just for right now, just for the sake of demonstration, happens to be right here, which gives us targets, their respective targets that we can expect that continuation for. So if this retraced up to this level and stopped right there at 297.39, and that was in fact the high of the pullback, right? We get that 25% pullback, and then we typically see H-shaped continuation. Once it hits that 25% pullback, it goes into indecision mode, and we don't typically want to buy anything between there and this. But now that we've had that pullback and it's validated and we're seeing an impulse to the downside, we're likely to come down here and test the low a day. We're likely to see that continuation to the downside. And because we've got that pullback and we know that it's just over 25%, we can look for a target, corresponding target in that relative same range on the extension tool. So if I draw these side by side, and I'll change the colors. If I draw my fib right there, oops, all right, you guys get the idea. It's roughly in place. There we go. But let me change that to yellow. I'll change the extension to yellow just so we can kind of see the levels. So really at the root of it, there we go. Dang it. At the root of it, the extension itself measures the pullback, right, and provides continuation targets. The retrace just measures the impulse and allows us to measure the retrace and categorize it. So at this point, we've got a retrace to, and the funnest part about this is you can, well, if I didn't draw them on top of each other. Okay. So you can actually take your proportions here and you can move the line down. So in this case, it's a 38.2. So I can just move this down to that 297.39. And again, assuming this is the top. So in this case, it's going to be 34.9%. So if I come over here and I move a level on the proportion tool for that, we can see that my target should be right here at this low. 292.23 should be the target for continuation if this high of the pullback holds. So if we get a confirmation here to the downside, and that direction persists, we should see that 292.23 level hit. Otherwise, this was not the high of the pullback, and we probably expect more indecision up here. So does that make sense? Yeah. I kind of went through that really quick. All right.
I got it. Anyone in the chat needs have any questions on what was just gone over before we continue?
I'm actually going to turn off all the other lines. Mm-hmm. And that's something too. When you guys draw your fibs, you don't need all the lines on there. I never pay attention to the 38.2% level. Or the 78.6. I just don't. It just doesn't do it for me. But does this make sense? You've got your impulse, retracement, continuation with an expected target here based on this height of the pullback. Okay, we got no questions. Everyone got it? Everyone's a fib master.
Waiting for the chat to say something. I don't see anything though. Looks like they got it.
Yeah. Who knows what Duck's eye color is?
I mean, I'm on camera all the time.
Exactly. who's been paying attention?
Eye color. I mean, like, judging
hey,
color, my eyes are very many options.
But there's a chance.
There's a chance.
All right, so
if Brandon do go with the deductive reasoning.
Hell yeah. So I'm just going to draw out the 61.8. There we go. I offset that just a little bit so that we can get in there and see kind of what the targets would be. So as an example, if we got I almost said an insult. If we have an impulse and a retrace and it does come up to the 61.8, we can use the fib extension to determine where that 61.8 target would be. Sorry. I'm dying here. All right. So if we got, let me draw a polyline here. So if we got impulse, retrace, and then continuation, that would be our projected target. And that is because in this case, we had bears jump in, bears jump out, bears jump back in. right? But enough of them took profit here for more to jump in here, so we get that farther out target. That's why it kind of works like that. Yeah.
Do you have anything else for extensions? I would like if you were able to go over time zones next. We did go over that
Ooh,
last.
time zones.
That's
Okay.
a fun one.
Yeah, so time acts as a support and resistance. So what we can do with that information is we can also, oops, where's my impulse? There we go. We can also draw out the Fibonacci levels across the x-axis. So not just the y-axis, but the x-axis. And what that can do is it can kind of help us time the ebb and flow of that volume and price action within the alignment of a third dimension or second dimension. Sorry, third. Jeez, yeah, third.
wait. What?
Don't worry about it. Let me just erase these other ones because we kind of know where the fibs are headed. So yeah, you do the same thing here. It's just a measurement tool that kind of helps us space things out, and we can kind of, if we just extrapolate this here a little bit, we can see the slowdown of time. And the mechanism behind that is that if we're looking at an impulse, we're looking at condensed price action or condensed distribution between supply and demand. And then as that process slows down and as it begins to expand again over time, we'll still see that same effort or the same distribution, but over longer periods of time. And it tends to release within the same kind of proportions as the Fibonacci numbers. So that's all it really is. It's just telling you kind of when or on what kind of time scale over time we're likely to see this kind of distribution activity.
Cool. Yeah, we went over that in the class as well as in our live. I hear that. If we don't have any more questions in the chat on Fibonacci, or if you don't have anything else on Fibonacci, Pookie, I do have something else that we can.
Ooh, what do you got?
Well, I'll give it.
We need to talk.
Last call on Fibonacci. Anyone? I know everyone is always asking about it.
Yeah, if you guys have questions about Fibonacci, now's the time to ask because I'm ready to go.
We are.
Give me one moment. Give me one moment. I'm sorry.
Literally just said now's the time to ask. Now you're leaving us in our time of need. And he's gone. All right. Well, I'm going to have Pookie go over some of the daily watch lists that we do daily. We're going to go over the one from today and just see some different using some of the stuff that we went over in this week and the prior week for charting. How he might chart out the daily watch lists.
Can't believe
you
just went on without me.
You see what Sergeant Brando says?
No.
He says, "Yeah, can you just run it back?"
Yeah. I think it's only fair.
I mean, thankfully, this is recorded for those of you who want to watch it. That's so funny.
Well, I'm going to be in the mountains. I can't watch recordings.
That's fair.
You need to be more considerate.
Anyway,
what's up?
Here, let me just stop and share my screen. I want to go over the daily watch list with you.
Ooh, which one?
The daily one for today.
The one I do or the one that Lee puts out in the morning?
Yes.
All right. So
there's two, huh? All right. So I know about the one that you do on the bot. You talking about that one?
Yeah, let's do that one.
Where's Lee's daily watch? I didn't know Lee had one. I should know. Oh, there it is. It's right next to it. I see it now.
Present,
I know, right? I thought that y'all worked on that one together. Now I'm seeing it's like basically the same thing but different. Okay, let's go over the one that you do. We're gonna because you're the
same but different.
I did. Actually, no. Let's go over Lee's daily watch list because you know all about your watch list. I want to go over it as if someone's waking up in the morning, whatever, and seeing this watch list and I want to chart it out and use some of the stuff that we learned in our course to find their own levels and this, that, whatever when it comes to these different prices or different stocks. So let's go over the first one, which is HKIT.
All right. So for those who don't know, you can find that if you go into the stock day trade alerts. He usually posts his before 9 a.m. So it's just right here. It's just plain text. This one is as well, but
between yours and his, just you do yours and he does his.
So the one I post is typically based off of tickers that are on the weekly watch list, and they're more stable companies for the most part. He also does stable companies as well, but a lot of his are the cheaper, faster moving stocks.
So yours are the boring ones, and his are the fun ones. Got it. So let's go. Let's go over.
Yeah.
Let's go over some of his then. It looks like Ace KIT already hit entry, but we'll go over it anyway. So, yeah. All right. So it was an entry above 440. Target was 460, 480. If you were to look at this in the morning, I know now it's already hit entry, but like, what would you start doing to chart this out? As opposed to just putting a buy in at entry and then a sell target at target. How would you personally chart this one out? Using that alert and knowing it's on the daily watch list.
Yeah. So the first thing you want to do is plot those levels, right? Because then that kind of puts you in the mindset to see what the analyst was doing. So see the alert, add it to a watch list, and then just go through that watch list in your Webull, like I did here with the daily watch list, and then you can add those levels out as you get a chance. And then like this one was alerted down here, I think somewhere 8:55. So it was somewhere. Let me turn extended hours on. That'll probably be a little easier. It was alerted at 8:55, so somewhere right around this block down here. So the just drawing the level, I can tell that he was looking for a break above these highs, break of this level here, which acted as a support. So he's looking for a break of a key level up into a potential momentum zone. So that's what we got. The first target here was 460. 460. And second target was 480. So I'm just going to plot these levels out really quick. And what you can do also is when you're drawing, if you click this button right here, so if I click this, I can just keep drawing lines until I'm done. And that makes it a lot faster and easier to draw those levels. You just got to make sure that the price lines up here on the axis. So once it's activated, a stop loss kicks in around 420. In this case, it's 420. It's a stop loss. So the alert isn't considered active until it breaks over this level, which it did right here, right at 9:11. So 20 minutes before market open, this thing broke over that level. So that's when you would take your entry in most cases, as long as the volume has to make sense. There has to be some other factor that it wants to move. But in this case, he saw consolidation. He's just looking for a break over that. We got it, right? So easy trade. And then you can set your sell limit orders right off the bat. You could just sell. You can set them as soon as you place that buy, or you can use bracket orders if you're in market hours. You can't do that in extended hours because it's based on market price, so it won't trigger. But you can always just set limit sell orders at those levels, or you can use hotkeys and things like that. So I have some hotkeys set up. I can just boopity boop, and then once you're in, you just watch the idea. Large body of profits, and then that way, if I sell 75% of my position right here, what that does is it takes this entry to target range. It locks it in for 3/4 of my money, right? And then this entry to risk position.
Pookie, your AI to voice filter isn't working. You had to fix it so that we.
Oh no!
You're sounding all robot-y, and
is it
the AI in you is showing.
Sorry. Is it bad now?
How
about now?
Well,
how about now?
Oh wait, apparently it's both of us.
Oh. What about now?
Now it's good.
Oh, okay. Maybe it's Nikki.
Maybe it is.
Okay, so as long as you guys can hear me, I'm just going to keep rambling. So the green box is the entry to target. The red box is entry to stop loss. So what we're doing is by locking in 75% of the profit, or majority of the profit, the majority of the position, I'm sorry, at the closest safest target, what we're doing is we're taking this range and we're extending the distance that it's allowed to go before we become break even, and we're tripling it. So if you sell 75% here, you got to go 3 times as far plus back to entry in order for that position to lose those profits. So by locking in the majority of the profits, we're extending this range, but we still have the stop loss in place, which means it can't get down to here unless it gaps down really hard, obviously. So that guarantees net profit, which means we can do that for all of our trades and become net profitable over time. The risk is, of course, that you're just sacrificing a little bit of profit potential up here above there. And that's okay, right? Because you don't necessarily want to hold 100% of your position just in case it goes up here when you can guarantee yourself a net profit down here. So that's why I try to push that. And I do it personally because it just works more effectively. It's a nice trade-off. And you could just draw these levels out. And at the time when this was alerted, it was back here somewhere. This is kind of what Lee was seeing when he put that on there. He saw a key level here. He saw a resistance up here and then a break plus a little bit of distance over here. I'm assuming he lifted a little farther left and saw another level. And the stop loss right here is this nice tight support right before that that pushed out. So this wouldn't have been an entry or a stop loss because it's not active again until it gets to this entry price. And then the idea is that we would see a clean break above, and that's exactly what we got. Just a clean shot right up to $4.99, and then it fell off, and then market open, it sold off. They bounced right off this key level here where the stop loss is and just blasted up again, and then sold right back off to that same level. So it's really just trading the levels on those. And you can see that acted as a resistance multiple times throughout the morning, and it's just failed to break back over that. So that's why we don't want to be in that trade below that level.
How about, so let's go over one that's possibly not already at target. Let's do CBAY, CBAY.
CBAY, all right.
Can you learn this going $16?
All right, let me pull up the boop. I gotta look up the actual alert. Okay, CBAY above 16. So I'm just gonna draw these levels here. $16. Okay, and then the first target here is going to be 1670. And then the second target is going to be 17, I believe. 1570, I'm sorry. No, 17, I apologize.
Yeah, I think 1570 is a stop.
Yeah, and then the stop loss here is 1570, as I was saying before you cut me off. And this was posted at 11:55 a.m. So let me just try that at 11:56 because, that 1 minute, whatever. So in this case, it looks like we got price action above here. It didn't hit target. It just came down and hit stop, and that's okay, right? Sometimes that just happens. Now, in this case, it was posted here. He probably tried to get it out as it was starting to push, and then the volume fell off, and that's something we can't control. So in this case, it would have just been a small stop of 1.78%. And you can see the profit potential here is 4.3%. So to that first target. So, losses happen, but the important part is that we can control the size of those losses at all times, unless we're in a halt or something crazy, of course. And then this one just never pushed back over that level. So it's a dead play.
So using TA, pretending that we didn't know what just happened, between now and the alert, would this, using your charting, using your TA, what would you have done to decide whether or not it was worth entering for you personally?
I probably would use this level here. So obviously you've got your pre-market levels. You could draw those or you don't have to. I don't like this time frame, so I'm going to kick it up a little bit. So we've got an impulse here, so we could use that fib, but that looks like a deep retracement, so maybe we wouldn't have taken that one. So maybe we can kick it down to a smaller time frame because we have this impulse, or we can look at it from a bearish perspective and we get a beautiful impulse. Now the critical part here is not to let confirmation bias step in and say, oh, yes, you should have been bearish and blah, 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 because that is not effective. You can't do that and develop good habits. So if we're looking at this from a bull perspective, I would have drawn a fib from there to there as the impulse. First candle to the last candle of the impulse that forms higher lows, 5 or more in a row. And then we would look in this 50 to 61.8 for a confirmation. In this case, we didn't see it. So there wouldn't have been an entry on that. So that impulse retracement continuation play would not have had an entry.
I'm glad you're able to use Fibonacci since this is the class topic for this one, and to see, to watch that, it wasn't even the entry level. That's perfect.
Yeah, and the other alternative there is just to use engulfings with very small risk. So you typically want to look for some relative price action, and then you want to look for the minimal risk. So in this case, you got a super small risk here of about 18 cents. So I'd say maybe 20 cents or less would be good for this one as well. And you just look for opportunities. You could draw a little, let's kick it up to 30 cents. Why not? Because it's a $15, $16 stock. So if I draw a bracket here that's 30 cents in size, I can just look to see, like, this would have been an entry. but this was earlier in the morning. So let's look at the 8:55 range. Oh, where'd my bracket go? All right. Okay, so 8:55 is right around here. So what I would be looking for is breaks of red candles with bullish activity, less than 30 cents in risk. So in this case, we would have had a nice tight risk right here. This candle right here broke over that, and that fits within the range. So that would have been a good entry. Now, whether or not it's profitable is kind of irrelevant because we have those tight stops. And as long as the trend is going in that direction, we should be net profitable. Otherwise, we're managing our risk and keeping those losses nice and small. Here's another one right here because we get that bullish engulf, and it did push up, but we'd have to measure these to get that 2 to 1 or I'm sorry, 1 to 2 or 1 to 3 risk reward. So if we just look at these candles right here as opportunities, let me just move that over here. These are the only two that we're given on the 2-minute. So let's go ahead and look at those, and we'll map out the appropriate risk levels. So the open on this one is 16.35, so we can set that entry to 16.36 because we want to be 1 cent above. And the stop loss would have been 1 cent below this candle's low. Okay, so we're treating this like a science, okay? And then we take the profit and we can bump it down to 2 to 1. Oops. Or I'm sorry, 1 to 2. I keep getting those backwards. So in this case, it would have been a loss of 17 cents. Okay, so let's look at the next one. This one is a nice tight stop loss. So in this case, the open of this candle here was 16.02. So we push this up to 16.03. Oh, it already is. And then the stop price would be 15.99. And then we get that 1 to 2 risk reward just for that. It's a 4 cent risk. So we know it's going to be an 8 cent profit potential. So 16.11 should be our profit for a 1 to 2. And that's where we lock 75% of the profits. And then anything beyond that is extra profit. So in this case, we would have hit that 8 cent target. We would have locked in the majority of our profits, and we would be at a net deficit at this point, unless we lock some more profits up here, but we can't guarantee that. So it would have just been a losing trade, and that's okay. We just get what we're given. So either way, this would have been a losing trade, unless you caught it like back here before the watch list was actually posted and you violated the laws of space-time somehow. But this highlights that as long as we have a system in place and we can follow it consistently, I'll take an 11 cent loss, 17 cent loss, 8 cent loss, and I can get a $3 win at some point just by letting the trend breathe and go in the right direction. These are so insignificant, it really doesn't matter, especially when you're trading equities because you don't have theta and IV and stuff muddying things up.
Yeah, the nice thing about this, because this is all on the same watches that Lee put out. These are all breakout level plays. Once you like he said, once they hit entry and start moving up, think about raising your stops. Like these are definitely the kinds that like you said, very small, limit your risk type deal and hope for that breakout above and make that big reward, or even just at the very least targeted rewards. I'm wondering when it comes to your premium daily watch list because like his are a little bit different. They are breakout plays with, a direct entry, a direct target, stop loss. We know the direction of the play. With yours, it's more of like an analysis watch list where you have a bullish possible entry and a bearish possible entry because, obviously we can't predict what's going to happen, but we can definitely be set up, depending on, for either or to happen, whether it be bullish or bearish. Let's go over Uber. I'm curious how one could, look at this, look at your watch list and then look at the levels that you have and then kind of do their own TA using whatever it may be, whether it be Fibonacci, support, resistance, trend line. There it is. Oh, yours is fancier than mine on the Discord. I like that. Wait, what was next? What was that image next to Uber? Why did it have a little hand thing?
That means it needs to hold that level.
Gotcha.
Yeah.
I do love Uber, Latvia 90. I really do. But yeah, so let's talk about someone, somewhat ish new to trading, but understands, what they learned here at Penny Boys. They understand charting and all that stuff that we learned in the premium course. They're looking at Uber. They see your bullish entry. They see your bearish entry. What can they do on their own using TA and charting to kind of get a better gauge of what may or may not happen and how to play it?
Yeah, so in this case, these are typically set up on the higher time frame. So 30-minute time frame is a really good way to identify the levels. And then the 5 minute, 2 minute are good for identifying specific entries. So similar to how we did the super trend, we want to use a higher time frame as a filter, if that makes sense, and then a lower time frame for actual signals. So in this case, we're using the higher time frame, 30 minute, roughly, maybe a 1 hour, to identify the levels of value. And then we're looking at the lower time frame for the actual confirmation within the candles to identify whether or not we should take an entry within that overall setup. So if we look at the 30-minute time frame, where did it go? My stop loss line disappeared.
I hate that.
They
need an undo button. It's been so long and they still haven't done it.
Yeah. Well, the problem is it's just so close. So I'm going to turn the extended hours off. And you can see that if we just look at these levels here, this is just where the price has turned around, held a support. If I turn this back on, you can see that it kind of shuffled around a little bit pre-market as well. So it does. These are just important levels where price has, turned around multiple times. It's held. It's had repeat visits. It's had strength at those levels, good volume, things like that.
Levels of interest.
Yeah. And this 45.24, 45.64 just looks so small on this time frame. So we can just look for a lower one here. It's only a 20-cent difference. What have I done? What have I done? Where's my
line? Where's my line?
Yeah, where did it go? What's my line?
What's my line?
So okay, sorry. So I just miscolored this one. No, that's a target. What am I doing? Sorry, give me 1 second here. I'm having a brain day.
I was just DMing Nikki about that. I'm like, I'm so tired today. I'm like trying to follow along.
Yeah. So okay, I see. All right, I see what happened here. So this level, we actually set this as it's a level of contention, right? Because on the higher time frames, it has good value multiple times in both directions. So it is a bearish entry level as well as a bullish entry target. So it's rare to have this happen, but basically if the price comes from underneath here, let me just kick it down to the 5 minute. If the price comes from below the 45.24 level, then we typically want to look for a bullish position off of that. If it comes down, tests this, holds it, or dips below it and pushes up, that's when we take a bullish entry. Or if it fails to hold this level here, that's typically when we look for a bearish entry. So these are kind of flip-flopped a little bit today. And that's only because this 45.64 level is so strong. It kind of overpowers the level below it. So normally the stop loss would be below the bullish entry, or the bearish entry would be below the bullish entry, and we just look for a break to the downside. But we're looking for a fail of this level or a hold of this level. So if it fails, pushes down, we have the potential to push down all the way down to 44.75. And if it falls down here, holds, and then pushes up, then we look for the bullish opportunities, 44.75. I'm sorry, 45.64 again. So it's kind of a dual level for that initial take profit, and 46 as a secondary target. So in this case, it held the 45.24 level on the lower time frames, and then that would have been the entry criteria, is just a push off of that level. So first target, second target, and beyond. We have higher lows here, so we just move our stop loss up. Does that make sense? That was a lot of explaining.
Yeah. Anybody in the chats have any questions?
There's the 30 minute, just so you guys can see it. Do the levels make sense? Like this guy right here, does that make sense? Get a little bit of rejectorino.
Reject.
If we go up to the daily, you can see that these are also valuable historically. Apples and bananas. Yeah, are you looking for the, I assume maybe 2 minute we'll look at? What are we looking at? Which time frame? There's a bunch of fibs every day all over the place. That's the best part.
Yeah, it's true.
2 minute. All right, we're looking for bullish or bearish, and where? We're looking at this guy, this big sell-off into a shallow retrace. Are we looking for this impulse into a healthy retrace? What are we looking at? We're looking at this guy for a shallow retrace and a massive buy, and then kind of a trickle. You want to do them all? I'll just do them all. All right, let's do them all.
Maybe for a sell off to a retrace.
Yeah, we'll cascade. Watch this. It's going to be fun.
Potential entry, possibly.
So fib retracement, we get this high to that low, right? That's the first and biggest retrace, is that impulse for the market gap. We tapped the 50% level, and now we're seeing bearish continuation. Easy peasy, right? So looking at a lower time frame, or same time frame, but a lower scope, right? We have a bullish impulse right here. So there to there, right? Because this candle right here breaks the series of higher lows on the candles. So this is the break of the impulse. Therefore, this is the high of that impulse. So let's go ahead and look at that. We got a relatively shallow impulse here. Didn't quite come down to the 50% level, but we did get a nice little double bottom above it. This is a good wide segmented midsection. We got volume at the root, and we broke above the neckline, so bullish, right? Then we've got ourselves a mess, so we can't really use much there. But this is an impulse right here. So let's go ahead and measure that as well. That'd be right there, I guess. Again, it didn't quite come down. So this tells us there's a lot of bullish strength, but there's not a lot of bulls taking profit. So in this case, we got another shallow retrace and then a massive bull rally. In this case, we got another impulse, right? So let's go ahead and measure that. This one went bearish. It went below the 61.8% level. So that tells us there's a lot more bearish strength at that point. So we can expect a new low. And it didn't quite happen, right? So that still shows us that there's bullish strength in the mix, but we never saw a bullish confirmation in this zone right here. So there wouldn't have been a bullish entry to be had there based on this impulse, right? So let's look at it from a bear perspective. So if we've got this impulse here and we come back perfectly within the 50 to 61.8%, and we get ourselves a little continuation. We got that lower low. So let's go ahead and draw that. Okay, so we got the high to the low to the pullback, and then actually blasted through the 50, 61.8% target and went all the way down to the 78.6 on the continuation impulse. So easy enough, right? Does that make sense so far? So the bullish one didn't have an entry because we didn't see a confirmation in this area. The bearish one did, and that was the profitable one. So a lot of times if you just kind of let the chart tell you what to do, you'll end up with a better chance of success. If you try to force things, like here, if you just saw this impulse and we're like, oh, we're going to get retracement, and you just bought right here as soon as it hit this, or you bought here, or you bought here, any of these were not good confirmations. There's no sign of strength here other than the fact that it pushed. You're going to lose more often than not. So we can avoid all that by just using the tool as it's intended to be used and understanding what it's telling us. So in this case, we had that nice, beautiful retrace. We got a good confirmation right here, bearish engulfing, and we got our continuation right there. We also had another bearish engulfing right here. So either of those two would have been nice, clean entries with defined small risk, and you could have taken either one of those and made a profit. We got another impulse right here, so let's go ahead and measure that. Okay, so in this case, again, we didn't hit the 61.8, but we did get a 50, and we got an engulf right here. Oops, it moved on me as I was drawing that. So we got a nice engulf here with a very small risk, right? That's the key, is just looking for small risk. And then we got a, we probably hit that continuation. Let's see, here we got 177.57, boopity boopity boop, and then right there. And then the target for 50% is right here at 176.70. So let's see if we hit that. Yes, we did. Okay, so that would have been another profitable bearish trade. Then we got a bullish engulf right here. I'm sorry, not right there, right there. In this case, again, there's no confirmation here, so there's no trade. So we're not putting money at risk for no reason because we went super bearish and it just didn't show us the retracement is broken at that point. It's too bearish, so no entry. Then we got this nice bullish guy right here. Let's go ahead and measure that. And you can see at this point we're below the 61.8, which means we're bearish. So there's no bullish entry to be had based on the fib retracement strategy anyway. Now we have a bearish impulse. So let's go ahead and measure that. And you can use this one or this one. It doesn't really matter. I mean, these are ranges, so you don't have to be like hyper specific. But if we're a bear, right, because we're looking at a bearish impulse for potential continuation, we're going to want to see the price come up here. Do a little bit of this, a little bit of that. And that would be our entry on this pairing of engulfs. And then we have a nice tight stop loss right here with a clean entry right here. And then a defined take profit somewhere in this area, depending on, you know, whether or not it was an accurate 50 to 61.8%. Does that make sense? I know it.
Yeah.
No, I was gonna say it might seem really complicated, but I'm simplifying it as much as I can.
Yeah, and a lot of this is repetition. I mean, we're gonna be like I was just talking to, I think it was Nikki and a few others about our new schedule. We have now 7 PBU lives a week. That's around like 7 hours, like 10 hours a week. And that between that 8-week course, we're looking like at 75 hours of live education in those 8 weeks alone. So there's like, if you don't get it now, like, trust me, there's gonna definitely be another chance. And just, you know, just if you just keep tuning on. I know I see Stickman, I see Sergeant Brando,
Dugo.
yeah, a whole bunch of other people, you know, who are always tuning into like almost every stream, which is that's dedication. That's like 8 hours a week now. You know, that's the key, honestly, is just repetition, education, and doing what Latvian did there and ask questions. Like, that's the best way to, you know, to learn, is just to, you know, ask your personal, you know, specific questions.
That's the value here, is if you're not asking questions, you might as well just be watching YouTube videos.
Right. And then that's why we do these lives. Like, you know, it's yes, to educate, but also to get your person, like, get the exact question you have answered.
How can we explain this in a way that so many people can understand in a better way? So every time you guys ask a question, we say, okay, they didn't understand that part. We can fine tune that part and make it a little more digestible. So one thing that I will explain right now is that what I'm doing when I go through all these strategies is it doesn't matter what strategy you use. That's something that a lot of people get way too hung up on. Technical analysis doesn't mean shit. I'm sorry, it doesn't. There's a hierarchy for things. And that's what I want to instill in people. It's not, you know, this strategy is better than that strategy is better than that strategy, or that this indicator is better than that indicator. I can walk you through how to be successful with all these indicators. The hierarchy is understanding that all of these setups have optimal risk reward for what they are. They make sense. They're in the right locations, and they're easy to identify. And if you have that little iron triangle, I don't know, is that a controversial term? Iron triangle. I think it's like a World War II thing. Anyway, if you if you have those 3 points in place, fire triangle, we'll call it that.
That sounds way more controversial, or it could be.
If you have those in place, if you have minimal risk exposure, if you have appropriate position sizing, that's part of risk exposure, so that's still 0.1. If you have a trade that is nice and clean and makes sense, and you can be confident in it, that is a huge advantage. And if you have defined reasonable risk to reward profits, right? If you have reasonable profits that also make sense and there's nothing major in the way, you should be net profitable overall. So it's just a matter of finding the consistency and the specifics ironed out for yourself that you're comfortable with and confident in, and you'll just have to work at it. And that's why we want you guys here, so you can get that immersion, that exposure. And we want you guys to ask questions, especially about how do I use this? How do I use that? Because if you're interested in that specific setup, strategy, or indicator, I'll walk you through it all day long. I don't care. As long as it makes sense to you and you're not just blindly looking for the next strategy. So, yeah. Sorry, I have a part of my AI is Paris Hilton.
But no, really quick, because I do have to head. I have a call with Austin a minute ago. But yeah, like, it was like I learned about it like 20 minutes ago.
That's Austin.
Yeah. But yeah, like you were saying, you know, a lot of it's like, you know, when it comes to technical analysis, like Pookie was saying, like, we're teaching you a lot of stuff, and especially in this 8-week course, during these live courses, you don't have to use all of it. Don't feel pressured to use all of it, or to even, you know, master all of it, or even learn all of it. You know, it's really just what works best for you, like what strategy works best for you. I do got to hop off. I'm going to hop off the, I'm going to end the recording. Those of you watching, appreciate y'all for tuning in. Until next time, our next stream is 5 p.m. Eastern. Myself and BTCJ will be going over some more charting techniques with support and resistance, how to enter trades based off of that. But of course, until then, I hope that you all make some bread.
Hell yeah. Wait.